All right, guys. Good afternoon. Futures Brizio here. A little after 3 p.m. on Saturday, May 10th. Hope everybody's doing great. And yeah, again, guys, sorry I haven't made a video in a little bit. As I mentioned after the last one, I was going to be traveling, which I did. And I'm home for a few days, and then I'm heading back out again on Tuesday of this coming week for the rest of the week. So this will probably be my last video for potentially a week, unless I make one on Monday. But we'll see. I will be have some hotel time next week, so if there's anything going on, I certainly can jump on and make a video from my hotel room. I'll just won't have the graphics. But let's just jump right in. And today I just want to talk about again just some potential trend following type setups here. I'm going to be looking at Forex pairs and futures. And so let's just jump right in here and I'll tell you what's going on here. So this is just another way you can look at trending markets. And this is the 1 hour chart, which is really where I'm going to be concentrating. Now, again, guys, it doesn't necessarily mean you don't want to look at the higher time frame charts, but basically, I'm just trading off of the 1 hour chart signals. Everybody talks about top-down analysis, and that's not a bad thing. But what I will do is a little bit of a play on that is I will see a setup on let's say on this 1 hour chart. Before I get in, I will just click out usually to about the daily chart. And I will just make sure that I'm not trading into a major support or resistance area or just an area on the higher time frame where price, definitely reacted from. Okay. So it's not necessarily that I'm trading in the direction of the daily trend, but I will look at that time frame just to make sure, like I said, I'm not taking a trade heading into a major area where price is definitely going to react. Okay. So if you're taking a long, you don't want to be trading into the daily high, a recent daily high, because chances are as soon as you get into that trade, it's probably going to go against you. As the price reacts off that more reliable daily structure level. Okay. So that's the only kind of thing here. But again, given the fact that it's an hourly chart, these can be day trades. These can be short-term swing trades. And so as long as that higher time frame is not sitting at a key level, I'm not really too interested in what the higher time frame is doing. Okay. I know a lot of people are going to be like, probably not agree with me, but that's okay. You got to do what you got to do. And look, if you're going to look at the higher time frame, say the daily 4 hour chart, and only take trades on the 1 hour chart in the direction of that longer time frame on, say, the daily chart, that's perfectly fine. That probably will increase your win rate if, all other things being equal, assuming that the rest of your entry and analysis is correct. That will help you, okay? I'm just saying just the fact that we're not holding on to these trades for extended periods of time. Sometimes you could be in and out in the same day. It's not as important. Again, it's an extra level of confluence. If it is, like if you're looking to go short on this hourly chart and you go up to the daily and the daily is clearly trending down, great. That's an extra level of confluence. If the daily is going up, again, what you want to just make sure you're doing is you're not trading into a major level on the daily chart, okay? And, you may also have to keep your take profit levels at a reasonable amount if you're basically counter trading against the daily trend, okay? But remember, if you have a pullback on a daily chart, let's say price is going up and then it starts pulling back and going down. Well, that pullback on the daily chart can be a very significant trend on the 1 hour chart, let's say, or lower. And so it's definitely tradable. So again, it's not that I don't look at the higher time frame, but I don't necessarily just say, well, I'm only going to take trades in direction of the higher time frame. I'm going to be aware of what the higher time frame is doing, but that's not necessarily going to stop me from taking the trade. It will just, if I'm going in that same direction, I'll probably give the trade a little bit more breathing room. If I'm going against the higher time frame trend, I'll be more realistic at my profit targets and just make sure I'm not trading into a major level. Okay. But again, just as an example, a pullback on a daily chart is going to be a trending market on a short time frame, like say the 1 hour. Okay. So please just keep that in mind as you consider these things. Okay. But again, if you decide you only want to trade in the direction of the daily trend, even though you might be taking your trades off, say, the hourly chart, perfectly fine. Okay. You'll get less trades, obviously, but you could potentially, have a better win rate. But win rate doesn't mean anything if, you don't have good risk management, you don't have good risk to reward ratios. So all other things being equal, then yes, going in the direction of the higher time frame on the short time frame trades should help you, but not necessarily, because you still have to have the whole package in terms of the quality of that trade. Okay? So that's a long introduction to this, but I wanted to set that straight for you right now, because that might be a little bit of a shocker for some of you. Okay? Okay. So this happens to be the Kiwi dollar. I'm just going to quickly go through all these pairs that I've got up here, and then we'll flip over to futures and just look at a couple of futures markets. Okay, so in terms of the candles, you'll also notice a little bit different on the candles. These are Heiken Ashi candles, which I have started using more and more, especially in Forex. I'm not really necessarily sold on them yet in futures, but because Forex can be so volatile and choppy, especially on shorter time frames, and can be very well manipulated, I do find that they keep me from getting into trades too quickly. Now, they can cause you to get in late on a big move, like if you had a 1 hour candle that had a huge range. But for most normal trending markets, they should be okay. But could get you in a little bit late. And it could get you out a little bit late, where you could potentially give back some of your profits in a profitable trade. And it all has to do with how Heiken Ashi candles are calculated. They're basically the average of the one candle that closed is basically the average of the last couple of candles. So that's why you don't see any gaps on a Heiken Ashi chart, because it's averaging everything out. Okay, I'm not going to get into the whole calculation. You can just Google Heiken Ashi, how Heiken Ashi candles are calculated. They are a little bit different, but they do tend to smooth out noise. Okay, and can potentially help you make a better decision about when you're going to, say, enter a trade, maybe during a corrective move. The Heiken Ashi candles might give you a better signal of when to get back into that trade, so you're not getting in too quick, too early on a fake out, when actually that price has not confirmed that it's ready to start going back in the trending direction. You might get a false signal with a regular candlestick, where the Heiken Ashi you might not. So again, I use might and maybe, because there's no guarantees on anything. But again, I do find Forex to be very conducive to Heiken Ashi candles. Okay, so it doesn't mean I won't look at regular candlesticks here. Like I said, in particular, when I'm setting profit targets, a lot of times I will go flip back over to a regular candlestick chart to help me fine tune that profit area. And if I'm looking to manually close a trade, let's say it's in profit and it's getting close to my take profit, but I'm getting a little concerned about potential turning and giving back a lot of those profits, I will flip over to regular candlesticks and try to get a better view. But at the same time, you don't even necessarily have to even do that. Instead of flipping back to regular candlesticks, if your trade is on the 1 hour chart, then maybe you're just going down to a 10, 15, maybe a 5 minute chart, even with Heiken Ashi, and you're just looking for market structure change, because that's all I do basically anyways. I'm just trading off market structure. And so even though Heiken Ashi candles can be a little slow compared to a regular candlestick, if you go down to a short time frame, you're basically going to make up for that. And again, I'm just looking for switches in market structure. Okay, so I technically don't need to use the regular candlesticks at all, but they're there if I want to. Okay, so I'll show you a little bit of this anyways. The other thing is the CCI indicator at the bottom here. This is the CCI Commodity Channel Index indicator. Nothing special. It's it's an indicator that's been around for decades. I have it set to a period of 14 at the close, which I think is the default setting anyways. I don't have the overbought and oversold levels because I'm only using this on a zero line cross for re-entry. Okay, so I don't really care about the oversold and the overbought levels. So I took those levels off. I only have the zero line here. As you can see, this dotted line is basically the zero line, because this indicator will flow between pretty much set areas. And so the zero line is a nice thing. And so we can get into that a little bit. You don't need to use the indicator, by the way. You can just do this just with the Heiken Ashi candles. Or you can use another oscillator or any other type of indicator that you want if you want an extra confirmation for entry. But I find the CCI works just fine on either a 10 or a 14 period setting. The 10 is not going to will give you slightly earlier. So you can use a 10 or a 14. I go back and forth. This is right now is set for 14. Okay, so let's just look at Kiwi USD. So I like to just look at what is price doing right now. So I like to find the last recent swing high or swing low on the chart. In this case, it's a recent swing low right here. Okay, so in this case now I'm saying this price is going up. Okay, because we put in this low. All right, and you can see it did reject. And by the way, guys, wicks on Heiken Ashi charts are not the same as wicks on candlesticks, but there is some relation. You still can have a big Heiken Ashi wick, and that definitely can show price rejection. But wicks are not always just like, oh, price is running out of steam the way a regular candlestick would have. Okay, so that's important to note. But this is a fairly big wick here. So price was going down. It did kind of reject here. Then we went up. We tried to go lower right here. We put in this higher low, and then we broke that structure again. We went up, put in another high, and then looks like we're potentially pulling back again. Okay, so what am I looking for here? I'm sure you can guess it. I'm looking for longs. For extra confirmation, although not 100% needed, what I would like to see is this CCI indicator, and I'll zoom in a little bit more. The CCI indicator cross back below the zero line during this pullback phase, which it's pretty close to doing that now. Obviously, the market's closed now. And then I would like to see a blue candle, a bullish Heiken Ashi candle reform, and at the same time see the CCI indicator starting to cross back above the zero line, which would indicate potentially a reestablishment of the uptrend. And if we just go back to the last signal right here, so we had this pullback right here, then we had the CCI break the zero line right here. Okay, so either this candle or this one, and that would be a buy entry. Okay, you put your stop just below the recent Heiken Ashi, the bearish candle to this little pullback. You don't even really need to put it down here, although if you want to give the trade extra breathing room, especially in a volatile market like Forex, you certainly can put it down below the next according swing, which would have been this one. But at a minimum, you want to put it a few pips below this low. But remember, like I said, Forex can be really, depending on your broker and depending on the time of the day and the news, you could easily have your stop hit on a liquidity spike down here below this low, and it would take you out and then go higher. And that's it can happen in any market, but especially Forex. So I would recommend, or at least what I like to do, is put my stop at the next swing point, which in that case would be below this low down here. I put my stop down here, would give me plenty of breathing room. This should be more than enough room, unless there was like some just crazy news thing that caused it to jump down like that. But just in the course of normal liquidity in moving markets, this would give you plenty of breathing room in case the market did come down here and retest this low, so you don't get stopped out. Only see the market go in your direction. So we had the CCI cross back above the zero line. When that happened, we didn't actually even have a blue candle yet. I mean, I guess theoretically it would be this one right here. So at the close of this candle, you can go long, and then, again, put your take profit down here and just let it go. And then we did go up, and then we pulled back again here. Okay. So assuming that this uptrend is going to continue, we're going to wait for the same thing. We're going to wait for the CCI to dip back below the zero line. It doesn't have to go far. In fact, I would like it to not go any lower than this, because that, if it stays, then again, that means the indicator is also making a higher low besides the price. So I don't need to see this really dip far below, but see it dip below, and then wait for a blue candle here to form on the Heiken Ashi, and then just go long at that point. Put your stop. Again, you could put your stop below this low. It would be a conservative stop. A more generous stop would be down here. Again, the next one down, just in case price does spike down a little bit and then turn and go up. You would have a little bit of drawdown, but at least you wouldn't be stopped out of the trade. Okay, so practice good risk management. Okay. The other thing you could do is you could also go to a shorter time frame. Let's say back here when this signal was given. Although I don't really think you need to. You could go to a shorter time frame and look for a market structure shift back to the upside. So if we want to do that, and I wasn't going to do this, but just for the heck of it, let's just look at this area. All right. And we'll jump down. We'll start with like a 15-minute chart. And, I don't really see the market shift here on the 15-minute. That would not have given you any better entry than you got on the 1 hour chart. I mean, I guess you would have gotten in maybe like here instead of over here. But again, the lower you go, the more chance that these are false signals. But certainly, we got this little tiny doji candle on the 15, and you did have CCI crossing back. So certainly, yeah, you could have done that on the 15. But then again, see, you got a false signal right here. See, on the 15, price crossed back above right here on this blue candle, and then what did it do? It went down. Now, again, if you had a proper stop loss placement, this wouldn't have bothered you. You would have been in drawdown for several hours, but you still wouldn't have gotten stopped out. But this is what I mean. The lower you go, the more you're going to have issues with potential false signals. Okay, so that's why I like to just stick to a little bit higher time frame, and the CCI and the Heiken Ashi will tell you. Go to the 5-minute, look at that area there on the 5. Again, maybe right here, right, where price came down, rallied, failed to make a new high, a new low, and then maybe on this candle you could have gone long on the 5-minute chart. Okay, so again, if you want, you can go to the really short time frame and try to get that sniper entry, but just understand, just like whether you're using regular candlesticks or Heiken Ashi, the shorter you go, the more chance you're going to get a false signal. And you just have to be prepared for that. Yes, if you're right, you may definitely get a better entry, but you're going to generate more false entries, both on the Heiken Ashi candles and on the CCI indicator. You can potentially put yourself in a situation where you're going into big drawdown. And again, you can see that false signal here on the CCI here. Here's the 5-minute, crosses back above, right in here. You think, okay, we're going higher, and then boom, price tanks down. Okay, and if you had your stop sitting like down in here, you would have gotten taken out. And there's no reason for that, It's just, just wait until, price tells you what you want to do. If you want to compromise a little bit, then I would say use a 30-minute chart, because here's the cross on the 30-minute chart. It would be on this candle right here, which is not ideal because it has a bottom wick. And I'll just talk about that for a quick second. So this is not ideal because this Heiken Ashi candle has a bottom wick, and we like to see no bottom wick on up candles because that indicates very strong bullish action. But again, this still would be a decent entry, okay, and a pretty low risk entry, okay. And let me just talk about that for a second. This is another unique feature with Heiken Ashi candles. in a strong bullish move, okay, you will see no wicks on the bottom. You can see right here, no wick, no wick, no wick, no wick, all the way up here until we started running out of steam. Now you start seeing wicks on both sides. You will always see a wick at the top of a bullish candle, okay? All right, always we'll see, unless you're in TradingView, you can actually, I think in TradingView, you can actually turn off the wicks. I don't know why you'd want to do that, because the wicks help, point to where price went. But just understand, in a bullish Heiken Ashi candle, that upper wick doesn't necessarily mean that there was, a pullback or running out of steam. It could be if it's a really big wick. Some of that could be rejection. But understand, you will see wicks on bullish Heiken Ashi candles. But if the bottom has no wick, that's a strong move. Flip side for down candles, you can see these red ones. The tops have no wicks. See, strong, no wick, no wick, no wick, until we get all the way down to here. Finally, we get a small wick, and then that is where it's probably telling you the price is running out of steam. We get all these really strong candles, bear candles with no upper wicks, but we do have lower wicks on all of them. Again, perfectly normal. As long as they're kind of proportional to the rest of the candle, it's not a big deal. This one down here, like I said, is not really proportional. You can see the wick is almost as big, as probably longer than the body of the candle. This one is showing you rejection. But all of these are not. These wicks are pretty proportional to the size of the body of the candle. And it's not until down here when we started getting small range candles, upper and lower wicks, that, this little downtrend ran out of steam and pulled back. Okay. So that is a nice thing about Heiken Ashi candles. But again, strong bull candles, you'll have no bottom wick. Strong bear candles, you'll have no top wick. But you will always have upper wicks, okay, on bull candles. Regardless of how strong it is, there'll always be a wick at the top. And on a bear candle, you will always have a wick on the bottom, okay? Unless you have some kind of software that turns off the wicks. Like I said, I think in TradingView, if you put Heiken Ashi candles on your chart in TradingView, there's in the settings, you can actually turn off the wicks and only see the candle bodies. I personally wouldn't do that, but in MetaTrader, this is a plug-in indicator because MetaTrader doesn't have Heiken Ashi candles. This is a custom indicator. I don't think there's any options in the settings to turn off the wicks here, but I wouldn't anyways. So, okay, so that's that. So again, you can, stick to the 1 hour chart if you want. It might give you a little bit later entry. Maybe go to the 30 or the 20-minute chart. Maybe you get a little bit better sniper entry, but you don't have to. I don't know what. Oh, there it goes. All right. So, anyways, back to the original analysis here. What we're going to wait for is this CCI indicator to get below zero, start to cross back up again. Okay, and again, as an alternate, what you could do is once you start to see it get close to the zero line, you can go to your smaller time frame, maybe let's say the 30-minute, and you can see on the 30-minute we've already broken. Okay, so the 1 hour is pretty close. 30-minute has already broken the zero line, so now maybe you can keep it on the 30, and when this turns and starts crossing, if it does and crosses back above the zero line, and you get your first blue Heiken Ashi candle, that is potentially an entry. Okay, so again, guys, simple trend following. You're still using market structure. The only thing we're doing is we're using Heiken Ashi candles instead of regular candles, which can help smooth out the noise. And the CCI is just an added confluence that you can use or not use. I mean, I could forget about the CCI and just wait for a blue candle here and just go like that. But the CCI is an extra indicator because if you back test this, it is pretty good as long as you're trading in the direction of the trend. You can see when we were going down, when the price was trending down, like right here, right? So we had this pullback. We're clearly in a downtrend. We have this Heiken Ashi candle right here. This is a definite entry candle. There's no wick on the top, so this is a strong bearish candle. And at the same time, the CCI crossed back below the zero line, okay? Or was at least at the zero line, and there you go. Now, if I change this to like a 10-period CCI, let me just see here. If I change it to a 10-period CCI, that actually does give me a little bit of a better, it gives me a break down below the the zero line. But again, the more you shorten that, the more risk for potential false signals. So there's a signal there, and then we have another pullback here, and then we have this one. Now this Heiken Ashi candle is not great because again, it's got a wick on the top. But we did have a break below the zero line on the Heiken Ashi, so certainly in hindsight, this was a good entry. But on the very next candle, which if you got in right here, the very next candle had no wick on the top, this would have been, giving you some reassurance that it was going to go down. It took a little while for this to get going, but that would have been a good signal, okay? But we're only taking shorts at that point. So you can see that the CCI is pretty good at helping you find those re-entry points. All right, so with all that being said, let's just go out and we'll take a quick look at some of these other pairs, and then we'll move on to futures really quick. So here is the pound Canadian. You can see we're trending up. What is our last swing point was down here, and you can see we're essentially making higher highs, higher lows. This can be a really sloppy pair, but essentially what I'm looking for now, and you can see I've already got the arrows drawn here, is for price to pull back, zero line cross, and then back up for another long. Now, this is one of these ones where I can just look to the left here and say, okay, well, there is something going on up here. So if we go out to a higher time frame, you can see here's what I was just showing you on the 1 hour. This is a very conservative estimate. And then, of course, we've got this kind of really big, strong high up here. So this is what I'm talking about, taking longs into these levels. There's not like you can't do it because I already measured. I think from where price is now up to this first red line is still like 180 pips or something. So that's definitely tradable. Again, it doesn't look like a lot of room, but this is a daily chart. We're trading on the 1 hour. There's still plenty of headroom. Okay, but this is a conservative target. Once price gets here, I do expect that there would be a reaction. Now, whether we get a false reaction, price just comes off it and then breaks through and goes to this next level, I don't know. But if I was taking longs, this would be my initial price target, would be at this first level, because this is kind of, to me, like a retail trap area with lots of, potentially now would be like a fourth touch on this level. Because you had 1, 2, 3. If this comes back up again, it would be like a fourth touch on this level. But there will be a reaction. Whether it rejects down totally and reverses, or whether we, pull back a little and then blast right through it, I don't know. So if I was in a long, this is open. So this isn't one of these things where I'm saying you should look at the higher time frame, okay? But I'm not afraid to, and in this case, the higher time frame is up too. So there is good confluence there. But just recognize that where you've got these levels. All right, on to Euro Kiwi. Euro Kiwi, this is essentially still in an uptrend. Again, from this low point, this is our, the big external, what I call an external swing point down here. We're making higher highs, higher lows. As long as this area down here is respected, right in here where I have this line, this is still in an uptrend, okay? This is the 1 hour chart. So again, you could go to a 30-minute chart and you could just wait for price to break for a Heiken Ashi candle, preferably one with, again, no wick on the bottom, and then a zero line cross back up on the CCI. And you can see here's an example where the CCI would have saved you maybe from getting into a bad trade. You can see we were coming down here and we had 2 blue Heiken Ashi candles. Now, these are not good ones. They're big wicks, so that should have been your first clue anyways. But if you look down at the CCI, there was never a signal here. The CCI never crossed the zero line, even on this 30-minute chart. And so that would have potentially kept you out of a bad trade. But again, guys, we're just playing market structure here. But again, that would have kept you out of a bad trade. So let's see what happens. Again, as long as we hold the structure area this low, or somewhere down in here, then we're still basically looking for longs. Euro Aussie is very similar to Euro Kiwi. I'm not going to spend a lot of time. This one's not nearly as clean though, because you can see we've just been moving sideways here, chopping around. So I don't like this one at all. But Euro Kiwi and Euro Aussie usually move together. But in this case, the Euro Kiwi is a better pair. So this is one I probably would avoid right now. Swiss yen. Okay, so this one is a messy chart, because price has been moving sideways here. This is the 1 hour chart, but even if we zoom out, you can see we've been essentially range bound since for about the last month or so, essentially. I am in a short right here. You can see it. And the reason why I took this short, even though there's potentially, there was potentially in a long situation here, is because I looked at this as a higher low. I mean, excuse me, a lower, a lower high. We had this move up here that led to this high price. You can see got really choppy, came back to this level here. You know, it certainly couldn't get through here, and then it collapsed. This is a really shit poor entry, I got to tell you. But I only have a small, I think a half a lot on this position. And, you know, when I saw the price come up here and, you know, really failed to go anywhere and started rejecting again, I felt like this probably will go down some more. Okay. Because even when again, looking at the CCI, even when price started coming up again, the CCI really did not break above it didn't break here at all. And then here, just barely, and then it came right back down again. So this looks pretty weak. But you can see this is basically a 1-to-1 risk reward ratio. My take profit is sitting back at these lows down here, this red line. And that's because this is generally in an uptrend. And so this, to me, is a counter trend trade. And so I'm going to have a pretty reasonable take profit here. Now, if it comes down, it blows through here and takes out like this low, then certainly it's going to come a lot lower. And, you know, you can look to re-enter maybe for profit down to this low down here. But for now, it's a pretty tight TP area. Okay, we already looked at the Kiwi USD, the dollar Canadian. There's no opportunity in there right now. We had a pullback here. We had the CCI prices higher, so we'll wait for some kind of pullback here and potentially continue the uptrend. There's nothing there right now. The Aussie USD is just like the Kiwi USD, so we're not going to spend much time there. Again, you can see I've got it kind of drawn out. Like to see price, you know, maybe come down a little bit more as long as we don't take out a swing. And then, you know, this is kind of our external swing. Again, you can see the price rejection and then a higher low put in. So if this is potentially a higher low right here, then at some point this will turn and go back up. So it's just like the NZD USD. Pound Kiwi. So this is a really messy pair, I got to be honest. But this, you know, right now is trending up. And so, you know, we'll see what happens with this price. You know, we did have this swing low, led to this high, and now it's chopping around. Again, as long as we maintain this area kind of in general right in here, then, you know, you could, you know, still hold on looking for long positions in here as long as we hold, you know, basically this zone. Okay, so, but it is admittedly pretty messy. Dollar yen. I'm long dollar yen. This is a little bit of a risky trade because for one thing, I think the dollar has some weakness right now. So I am long in here. I'm not sure how thrilled I am about this trade, but we'll see because this could be a lower high that's going to be put in. This rolls over and goes back down. If we go out to a higher time frame, though, I don't really see an area on the daily chart that this is going to react off of, which is why I took the long, because I still felt like it had some room to the upside, even if it just comes back up to like somewhere in here. So, but this could be risky, you know, but you can see my stop loss is sitting down here at this swing that led up to this high. To be honest, if I see price come and take this low out right in here, I will exit the trade. I'm not going to let it get to my stop loss. I'll get out if it comes down and takes out this low right here. But my stop is sitting down here right now. Okay. But, you know, we are at an uptrend. But again, I wanted to point out one thing on this chart. And before we go away from this, you can see these rectangles. What I'm pointing to here is just the size of the pullbacks. You can see these pullbacks are really small, you know, 2-3 candles, pretty low range. And then we have this really big one. So just look at these pullbacks compared to this one. Now that doesn't necessarily mean price is going to reverse because all of this is just kind of like internal swing points going up here. These are just like little internal levels. And you can get, in one giant move up, you can get these little internal pullbacks. If I go to a higher time frame, you wouldn't even see these with the Heiken Ashi candles. This would all be blue. So, but this one definitely would show up. Let me go out to a 4-hour chart. Yeah, on the 4-hour chart, you don't even see those pullbacks. This is all blue heading all the way up here, okay? But again, we go to a shorter time frame, we can see it. So I don't put a lot of weight into that. But this is definitely, size-wise is a much bigger pullback, much more robust than these little ones. So we'll see what happens. But again, if we come down and take this low out, then I probably will close that out either way. So GBP USD. Again, a little bit of a conflict because if the US dollar is weakening, then then the GBP USD should technically be going up. And we were talking about taking long positions on Kiwi dollar and Aussie USD. And so that is also a conflict if those are looking to go up, but the GBP USD potentially looking to go down. But I'm going to take this off and forget it. You even saw that arrow. Where is the recent swing? Well, the recent swing, external swing, is right here. So ideally, even though we were going down here, this could just be a pullback and then go long. So in that case, it would not be a conflict. Okay. Again, this is our last external swing down here. We are pulling back. Do we get the CCI to cross back below the 0 and then turn back up, continue the uptrend? That would be the ideal. All right. And then lastly, dollar Swiss. Dollar Swiss has hit a major structure area up top. Okay, so if we go out, you could see it on that 1-hour chart, but here it is on the 4-hour. You've got multiple touches on this zone. I do expect a reaction down here, and looks like we are moving down. We'll see what happens. I certainly am not thrilled about taking longs in here right now, but this is pretty choppy and sideways too, so this would not be a favorite pair I'd be trading right now. However, if the US dollar is going to show some weakness, then we probably will see that this is a lower high somewhere in here, and then this will turn and keep going down. But we'll see. This is not one I'm going to take a trade on, though, right now. I can tell you that. So, all right. So, but you can see, guys, I just went through that. Didn't take that long. I did a lot of explaining. But these are just using simple market structure on a 1-hour chart, kind of identifying the trend based on the most recent swing, external swing high or swing low on the chart, which should stand out to you. And if it doesn't, then move on to a different asset. Okay. And then using the CCI, if you want, as an extra confirmation to re-entry. And I would say for re-entry time frame, you can stick to the 1 hour. If you want to go down a little bit lower, you can. Just understand you're going to generate more false signals, so just be careful. So because you don't want to get in too soon and end up in big drawdown, or get stopped out only to see the trade eventually go in your favor. So, okay, so 20-minute, 30-minute might be a good compromise where you can still get a pretty darn good entry without generating a lot of false signals. All right, so we'll just move on quickly here to futures. I pretty much have the same thing. You should see on the CCI on the futures, I have this set at 10, but again, you can make it 14. And again, you can see this is oil. I did take a long here, and you can probably see why now, right? We are trending up. We did have a pullback here, and then we had the CCI break below the 0, start moving higher. So I'm just simple trend following, and I'm targeting up here conservatively back up into this zone where there was previous resistance and liquidity. So there's probably a lot of sell side liquidity sitting up in here. So I'm hoping that we'll just can see this move on and at least get it back up to this area, which would be a nice little trade. That's probably just eyeballing it at least a 3-to-1. Okay. Okay. And on copper, copper overall, this is a big rejection wick right here. So these are Heiken Ashi candles. But again, this is definitely a rejection wick because you can see it's well out of proportion to the rest of the candle. So this one's a little weird right now, but essentially though, I think we're still potentially in an uptrend. If we can get like a pullback here, All right, CCI dipped below the zero line. If that plays out, we could see a continuation back up, but that one's not. It's a little ugly. And then lastly, on natural gas, these are the only three I'm trading now. There's nothing here right now. We're definitely in an uptrend. You can see all the higher highs, higher lows. We'll just wait and see if we can get a pullback here, a little bit deeper, CCI down to the zero line, and then back up. Now, and natural gas is famous, and oil can do this too, with these kind of like these big giant corrective moves right here. And this is one where you probably would have lost, right? Because if we go back to this area, we had price go up, make a new high, started coming down, and then we started going up. You can see, we had blue candles. We had the CCI give us a signal right about here. And then what did price do? It just went up a little bit and came right back down again. And, went down on another run down before it finally started going up. So again, depending where your stop loss was, this one maybe you've got knocked out of. If you put your stop right here, you definitely got knocked out there. I talked about putting your stops at the next further area out, which in this case would have been like right here. Maybe that one you would have gotten just nicked, either to stop you out, or maybe you just avoided it by like 1 point, because you can see price came back down to here. So you either have to, just take your lumps, and if you got knocked out here, fine. You're waiting for the next signal, which would have come right here, and then you would have gotten in, and then that one would have paid you. So, all right, so just understand it's not always going to work, and you're going to take losses, and you're going to get false signals no matter what time frame you're on and no matter what you're using, okay? Because there was a valid signal to go long right in here, but this market was not done correcting. We basically put in, for all you Elliott wave traders, and like an ABC zigzag correction, right? And this B wave, this is an ABC for you old Elliott traders. So this B wave often is a trap. And in this case, this was a trap, right? Because it pulled the longs back, the bulls back in here. This was a trap move because the correction was not over, and it had to go down significantly more before it finally turned. And so this is where you either have to just take your loss right in here, or have a much further away stop loss, which is, may throw off your risk to reward ratio and definitely gives you more risk in general, but it would have kept you in the trade though, and just have to, deal with the drawdown. But for most of us, we probably would have had our stop here, been taken out on this candle, and then price did go down a little bit more. But hey, like I said, you got another signal here, and this one would have paid you, and you actually could still be in this trade as we speak. So, all right. So that's it, guys. Heiken Ashi candles, trend following, identify the recent external swing high or swing low on the hourly chart, wait for pullbacks, wait for the Heiken Ashi candles to change color, preferably use a CCI or something similar with a zero line cross to help you gauge that re-entry point, which you can do on the hourly chart, 30-minute, maybe 20-minute. You can go down a little bit if you want to try to fine-tune that, but I wouldn't go too low. Watch your stop loss placement. If you can deal with the drawdown and proper position sizing, you want to go not to the obvious swing for your stop loss, but maybe the next one further out, which would give the trade a little bit more breathing room and hopefully keep you in the game, even if you go down to a little drawdown. But that's a personal choice. You have to decide. At the end of the day, even if you do get knocked out, you can hopefully re-enter. The problem is a lot of times you get knocked out and you're not in front of your charts. You get knocked out, and then the next candle price starts going back in your direction. You go and look at your charts later and you realize you got stopped out, but yet the price went in the very direction you wanted to go in, and that's extremely frustrating. So, but it happens to all of us. It's just the nature of the beast. So, all right, so I'm going to leave it there. Hope everybody has a great weekend. Make sure you smash that like button, subscribe to the channel. If you just find any questions or comments, leave them down below. And I hope you have a great weekend. And I will try to touch base next week, even if it's in a hotel room, just with some updates. And we'll see how this stuff goes. But I look forward to talking to you then. Like I said, have a fantastic weekend.